Good morning and welcome to today's workshops. My name is Erica Hubbard and it gives me great pleasure to introduce our speaker, Jim Lange, President of Lange Financial Group and noted IRA expert. Before we get started, I just have a few announcements. We're offering 3 workshops today and we encourage you to stay for all 3, whether you've registered for all 3 or not. In addition to the breaks between the workshops, each workshop will also have a 10-minute break halfway through. We'll be taping all 3 of today's events and making the videos available to clients, business friends, and prospective clients who are unable to attend. And I'd just like to thank you in advance for putting up with the inconvenience. The first workshop this morning that's happening right now is getting the most out of your IRAs and retirement plans after the Secure Act and Secure Act 2.0. And that will run from right now until 11 a.m. The second workshop, the Best Estate Plan for IRA and retirement plan owners, runs from noon to 2 p.m. And the third and final workshop, specialty session, Taming Parents' Financial Fears for Their Special Needs Child, runs from 2:30 to 4:30. I encourage you all to ask questions as they come to you today. Just raise your hand and Jim will call on you. Frequently, your questions spark some of the best discussions, and they also provide a great way to personalize the material in the workshop. So don't be shy. Answering questions is really basically Jim's favorite part of the day. We do, however, request that you silence your cell phones. Jim Lange, our presenter today, predicted that legislation designed to accelerate the taxation of inherited IRAs and retirement plans was coming over 6 years before the Secure Act enshrined it as the law of the land. Jim had the foresight that almost no other retirement and estate planning experts had. He understood that the end of preferential tax treatment for inherited IRAs and retirement plans wasn't a matter of if, but a matter of when. And instead of sitting around waiting to find out when it would happen, Jim and our team of talented CPAs and estate planning attorneys hit the ground running. They used their expertise to develop practical strategic solutions that our clients and other retirement plan owners would be able to use to defend their wealth and protect their financial legacies. And thanks to that combination of expertise and foresight, Jim and our team of tax and estate planning professionals have already helped hundreds of clients implement them as part of their holistic financial master plans. We'll get a closer look at several of those strategies this morning. But that foresight that Jim had about the original Secure Act and the preemptive planning solutions that he and our team developed in response, that's just one example of the kind of work that they've been doing for our clients on a daily basis for decades. Whether it's running the numbers on how the impending sunset of the Tax Cuts and Jobs Act could impact a client's financial master plan and helping them reconfigure that plan accordingly, or determining that by utilizing a strategic loophole, a client's heirs could save hundreds of thousands in taxes by making a Roth conversion of an inherited IRA 401k at their own income tax rate. Our CPAs and attorneys are always putting their experience and expertise to work to ensure that our clients and their families get the most out of what they've got. And today's event will be an excellent resource for anyone in search of great information and cutting-edge retirement and estate planning strategies. Jim is a nationally recognized IRA, Roth IRA, and 401k expert whose tax and estate planning strategies have been endorsed by the Wall Street Journal 36 times. His insights have also been featured in Newsweek, Forbes, Reader's Digest, Bottom Line, and Kiplinger's. He's a paid contributor to Forbes.com, and his peer-reviewed articles have appeared in Trust and Estates Magazine, Financial Planning, The Tax Advisor, and the Journal of Retirement Planning. Jim and our legal team have drafted close to 3,000 wills and trusts. Our accounting firm prepares 760 tax returns every year, and in conjunction with our money management partners, our RIA oversees over $900 million in assets under management. As a member of the team here at Lange, I've had the unique opportunity to get a behind-the-scenes view of just how much Jim cares about presenting great and topically relevant information in these workshops. And today's event is no exception to that. So without further ado, let's let Jim get started. Please welcome Jim Lange.
So I was bicycling in Johnstown, Pennsylvania, and the route took us through a darkened tunnel. And there was a big pothole that I missed, and I went down hard. Couldn't get up. The ambulance came. I was transported to the local hospital. I'm getting a little feedback, Eric. Maybe you can do something. I was transported to the local hospital in Johnstown. They took an x-ray and said, some bad news, you have a broken hip. The good news is we happen to have a surgeon on hand. You need surgery, and we have somebody who is on hand and able to do this tonight. And I said, well, out of curiosity, what would happen if I waited till tomorrow? And they said, well, you'll have a very unpleasant night, but you're not going to really have any long-term harm by waiting one day for the surgery. And I thought, do I really want the surgeon who happened to be on call, not a specialist, a general surgeon, in Johnstown, Pennsylvania, or do I want to be transported to Pittsburgh where they have specialists? And I found a specialist who not only did specialize in hip, but hip trauma. That means he's sitting around waiting for people to break their hip. But anyway, he actually did the surgery, and I put together a team. I had an acupuncturist to help with pain and help with the healing. I had a nutritionist who actually told me to eat a lot. They said, don't go on a diet at that point, which was counterintuitive. I had a physical therapist, and I did all that stuff. And when I went to see the surgeon for the first checkup, and I was in my 50s at the time, he said, this is the fastest recovery I have ever seen. The reason I'm starting with this is if you have a specialty situation, don't go to a generalist, go to a specialist. And sometimes that can just make all the difference in the world. So today we're going to be talking about IRAs and retirement plans and Roth IRAs. And a woman said, you know, I saw you here, Jim, in this exact room 30 years ago. And I was thinking of the Pittsburgh Steelers, you know how they have the retro uniforms? And I was thinking, I should just give the same workshop that I gave 30 years ago. And interestingly, much of it is the same. The concepts haven't changed. Now, with the Roth that came in 98, which is maybe 25 years ago, that changed quite a bit. But don't pay taxes later, except for the Roth, that has been the same for 25 years. So a lot of the things that I'm going to be talking about, even though I'm going to be trying to connect them with the newer laws, are still the same concepts that I've been talking about for a long time. So I'm even going to start with what I consider, quote, the solution for a lot of people. And interestingly enough, there's more people here that I know than don't know. And it was the same on Thursday too. So, and it's great seeing people, after the pandemic. And except for Thursday, this is the first workshop I've done since the pandemic. So it's a pleasure seeing people in person. And I always preferred in person to Zoom, although that's what I did during the pandemic. But anyway, the solution is a series of Roth IRA conversions over a number of years. Now, of course, it's going to be different for everybody, but that is most likely going to be one of our recommendations, whether you work with us or not, which is that Roth IRA conversions are great, but you don't want to do a big whopper one because that's going to push you into a really high bracket. And that's going to be particularly true after the Secure Act and after Secure 2.0. So here's the deal with IRAs, 401ks, 403bs, SEPs, KIOs, etc. All this money is taxable. And unless you ultimately leave it to charity, you might pay tax on it, your spouse might pay tax on it, your kids might pay tax on it, your grandkids might pay tax on it, but somebody's going to pay tax on this money. And up until the Roth, I used to say, pay taxes later, pay taxes later. That's our website, pay taxes later. www.paytaxeslater.com. So this is nothing new. But when the Roth came around, I had to change my mantra, which is what James Lange called it. I had to change it from pay taxes later to pay taxes later except the Roth, which is ultimately you're paying taxes now in return for tax-free growth. So that's going to be one of our very important concepts. So we're obviously going to talk about Roth IRA conversions. I always talk about Roth IRA conversions, almost no matter what. We're going to talk about the Secure Act, Secure 2.0. Secure Act was effective January 1, 2020. I think you could also call it the IRA Tax Confiscation Act, or IRA Owner Tax Confiscation Act, because that's what I think it is. I think it's horrendous that, and we'll get into the details of why I think that. And then Secure Act 2.0, which was actually helpful. So they're going in opposite directions. The other thing that I'm going to talk about that I didn't before, but I feel a little bit more comfortable talking about it, and one of the reasons is because so many of you have heard me before, and I wanted to have some new stuff for you also. So we're going to talk about some of the advanced Roth techniques that I would not talk to. If I was talking to a simpler group, like maybe a group of attorneys, you kind of have to dumb it down for them a little bit. But for this crowd, I can, I could go a little bit deeper. I better watch myself. We're filming here. Anyway, the other thing that we're going to talk about, which is a little bit different that I haven't done in the past, we're going to talk about going from the tax-deferred world to the tax-free world in using a strategy that I suspect not many of you are using. In fact, maybe none of you are using, but some of you probably should. And it can make a big difference down the road. And it could not only make a big difference in terms of saving taxes for the family, but it could also make a difference in the wealth utilization for the family. It's not all just about taxes. All right, so let's do some basics. And this is something that I have literally been talking about for 25 years. So for you veterans, you're going to go, oh no, here he goes again, because you've all seen it and you've all heard it. But it's critical. And that is, in order to really understand IRAs and to really understand Roth IRAs, you have to, in my mind, think about a new paradigm about money. So the way most of us think about money is whoever has the most wins. All right? I don't want to use that measuring point. All right, so Joanne. Joanne has $900,000 of after-tax dollars, money that she has already paid tax on. I have $1 million in my IRA. Well, I have more money than her, right? Because I have $1 million, she only has $900,000. But I don't want that to be the measurement tool. I want the measurement tool to be purchasing power. So let's say that we each want to buy a boat, and it's cost $750,000. Well, she can take her $900,000, buy the boat with cash, have $150,000 left, and then she can, she can get some fishing gear, and she can get some gas, and she can, have a lot of food, and she can have a great party and take all her friends out on the boat and go fishing and eat and drink and have a great time. Well, all I have, even though I have $1 million, since I have to pay tax on it, I can barely afford the boat. So I have no gas, no food, no fishing equipment, and her friends walk by my boat, wave hello to join her party. But the point is, I want to measure in purchasing power, not total dollars. Is that okay with everybody? If there's somebody that doesn't understand that, say that now, because what we're going to do is we're going to use purchasing power of whatever the asset is. And I'm not just talking about after inflation, I'm talking about after taxes. So $1 million in an IRA, depending on what tax rate you're going to use, but let's just round off and call it purchasing power of 750,000. Okay? So we're going to measure in purchasing power. All right, so Joanne and I each have $100,000. You could add another zero to this, the concept is the same, in a traditional IRA. And we each have $24,000 outside an IRA. All right? So we each have $124,000 total. And let's keep it simple. Let's assume a 24% tax bracket. How much purchasing power do we have with $124,000? 100 in the IRA, 24,000 outside the IRA. Well, if we cash in the IRA, we have to pay $24,000 in tax. So we each have $100,000. Okay? Well, Joanne, being the smart veteran of these workshops, says, hey, I want to convert that $100,000 to a Roth IRA. So she takes this $100,000, she fills out certain paperwork, or maybe somebody fills it out. Now that $100,000 goes from a traditional IRA to, it's now a Roth. And let's say the money is at Schwab or wherever it is, and they send her a 1099. And the 1099 says, please add $100,000 to your taxable income. So that's going to increase her taxes by $24,000. In this example, I conveniently have $24,000 of money that she's already paid tax on to pay the tax on the Roth IRA conversion. So she uses that to pay the tax. So she only has $100,000 left. All right? When she cashes in her Roth, how much money does she have to pay in taxes? Zero. So, measured in purchasing power, she has $100,000, and I, who didn't do anything, my purchasing power is $100,000. Do you see how on day one, it's a tie? Does everybody get that?
Just one question on that. You put $100,000 to transfer to Roth IRA,
Mm-hmm.
you pay 24,000 tax on it.
Yeah.
But suppose you already have $100,000 annual income, and don't you have to pay tax on 200,000?
All right. I get it. All right. So the question is, Jim, I'm going to question your assumptions. I'm assuming a flat 24% tax bracket. The comment is, if you add $100,000 to your income, then your tax bracket is going to go up. Okay? Well, that's true, which is one of the reasons why I typically recommend a series of conversions so you don't have that tax bracket creep. Now, that said, sometimes it's okay to pay increased taxes for a Roth. So I often go, for example, from a client who's paying at the 22% rate to the 24% rate. Now going, say, from 24 to 33, that's not quite as much fun. Okay? But I'm just assuming for this, from right here, that we're still in the 24% bracket. Okay? Okay, so what if I haven't given you a good reason to do a Roth, right? It's a tie. I'm not going to have you pay $24,000 to the IRS to have a tie. All right, who here will admit to being somewhat quantitative? Maybe you're an engineer, maybe you were good in math, maybe, and basically I'm talking about Algebra 1 plus. So who here will admit to being pretty good at math or that they were pretty good in algebra back when they had high school? I don't believe half of you. Meaning that the people who didn't raise their hands, I know some of you were good at math because I've met with you. So I want to make you math people happy, all right? What if we do some projections, all right? and we say, okay, let's do some projections into the future of where you would be if you had $100,000 in an IRA using certain reasonable assumptions, and you had $24,000 in after-tax dollars. The $24,000 is going to earn interest and dividends and capital gains, and you're going to have to pay tax on that. And then we're going to measure the IRA as time goes on with purchasing power. All right? Then we're going to put that on a chart. Then we're going to do the same thing for somebody who has the $100,000 in a Roth. Would that be helpful to prove to you that that's a legitimate comparison? Is that okay with you quantitative folks? Would it be helpful if we had this information peer-reviewed by the American Institute of CPAs, who have these nitpicking CPAs who just love to find your mistakes? But they said it was okay. Would that be helpful to you? All right. Well, just so happens that we have done that. We compared doing a series of Roth conversions between retirement and 72, which is the new age for minimum required distribution, might be later depending on when you were born, compared to, let's call it the status quo. All right? And here we have, oh, and remember, there's no required minimum distributions with the Roth for you or your spouse after you're gone. So we have, this is Mr. Roth conversion, or Miss, we'll call it Joanne, or Ms., or this is status quo. Even at age 85, the difference is more than $1 million. All right? If you live into your 90s, this much, is like $2 or $3 million. It's math. This isn't a matter of opinion. This is math. All right? So when I hear people say, well, my CPA doesn't like Roth conversions, my answer is, well, can I please see the peer-reviewed math that he did to come up with that assumption? And I'm not saying everybody should do a Roth, and I'm certainly not saying everybody should do a big Roth, but if we can mathematically get more purchasing power for you and your family, this is a very, very good thing, all right? And it's math. It's not opinion. It sounds arrogant, but it really is. So, most of you, and I've seen a whole bunch of you in person, and you're probably not going to believe me, but I'm going to guess that most of you right now in this room, or even in the virtual room if you're listening to this tape, most of you are going to die with more money than you have now. All right? That's really true, by the way. If you were younger, maybe not, but at the generation in this room, you guys don't take this the wrong way. You're not spenders, and you're not going to die broke. All right? And in a more basic workshop, I talk about which dollars you should spend first. And to oversimplify, I would say spend your after-tax dollars first, then spend your IRA, and then spend your Roth. And I think a lot of people get that, including my wife. So we have a 7-figure Roth IRA. She would eat rice and beans before she spends one nickel of that. And you think I'm kidding, but I'm not. That Roth money is sacred. In fact, I sometimes think about, well, gee, do I want to do some more Roth? Well, yeah, but then I could never spend it. It goes to our daughter, which is maybe what you want anyway. That might be one of the downsides of a Roth. Is that, in fact, since 1998, I can probably count on one hand how many people I think have spent some of their Roth, and usually they only did that based on tax brackets. In other words, they didn't pull out more of their regular IRA because that would have pushed them into an even higher tax bracket. My point is, if you do a Roth conversion, you're probably going to die with it. So now what I want to do, let's call Joanne Miss Roth and let's call me Mr. Status Quo. and we each leave our money, we have the identical amount of money, and we each leave that money to our child. Let's see where our child is, mine versus hers, not only during our lifetime, but even after we're gone and for the child's lifetime. So this isn't us, this is our child. And the difference is, my daughter runs out of money when she's 81. Diane's has 1.5 million when she's 81. This is the difference between your kid being broke versus having $1.5 million. What a difference. You know, I mean, it's astounding. So many people spend so much time on things that don't really make that big of a difference, or frankly, it's speculative. Should I buy IBM or should I buy AT&T? Should I do this? Should I do that? This is math. And if I used, and I was not trying to come up with the perfect assumptions, you know, to get the highest difference, you know, which I could have done. You know, I worked for Arthur Anderson, the tax department, coming up, and I remember there was somebody trying to get a loan, and if they made too much money, they didn't qualify for the program. And if they didn't make enough money, they didn't qualify the program. So we needed it to be just right. And instead of saying, well, how much money do you make? We said, how much money do you want to make? We'll do the adjustments. So my point is, I could have fooled around with the adjustments. But so, for example, this doesn't have an adjustment for the Tax Cut Jobs, the Tax and Jobs Cut Tax Act of 1997 sunset provisions. If it would have, then Joanne's kids would be even, you know, would be even better off, and then my child would be even worse off. This is just, you're changing people's lives. And you're changing your kids' lives. Okay. Yes.
They tax only once, correct? Once they inherit.
All right, so
Why she will be broke by 81? That part I.
well, because she's spending more money than she is making. All right? I don't have all the assumptions up here. And if you like, by the way, they're all in the book, which is going to be one of your bonuses. And by the way, it's the best book I ever wrote, by far. No, I took the best of all my books. I updated them all. I had 2 other people working on it, a number crunching CPA and a CPA attorney writer. Not attorney, I'm sorry, a CPA writer. And the book's called Retire Secure for professors and TIA participants. It applies, 90% of it applies to all IRA owners. And I have all the assumptions in there. But the reason why it's going down, in this case they're both going down, is because I'm assuming that your child isn't like you, because your kid is going to spend the money. You're going to save it, they're going to spend it. Is that better? Thank you. All right. I will say this, I did do one manipulation here. I wanted to show, I did it so that in this variation, I wanted a kid to run out of money. All right, and some of the other ones might be the difference between your kid having 3 million and 5 million. In this one, I wanted to show, hey, your kid could just run out of money because they're not savers like we are. You know, yeah, I mean, that's just the generation. You know, my wife and I had takeout the other day, and we drove to the place to pick it up, and our daughter, who doesn't even work, she uses DoorDash. I mean, that's just the way it is. My wife and I aren't going to change. She's not going to change. So rather than fight it, I just accept it. Okay, so ideally, the best time to convert. You're working, your income is up here. You retire, your income's down here. Then, and let's say you have a number of years of retirement, then Social Security and minimum required distribution come in. Your income's back up here. I've always said do the conversion when you're in your lowest tax brackets. That way you can do more Roth conversion cheaper than if you did it either while you were working or you did it after age 72. But interestingly, with some of the Secure Act provisions and with the higher tax rates that we're facing in the future, it might make more sense to do conversions even if you're working. And it might make sense if you're already taking your minimum required distributions. And again, it's just math, but what it means is that there is a wider group of people who will profit from doing Roth conversions than there was when I was first doing this analysis, say 20 years ago. Okay, what are some of those provisions? Before we even get into specifics, who here thinks in the long run that our tax rates are going down? Nobody. Who thinks that in the long run they're going to be about the same? All right, a couple. Who thinks in the long run they're going to go up? Well, yeah, I would agree with you. And I don't want to get political or be an economist, but we have a lot of debt and we're not paying it off. It's getting worse and worse, and someday somebody's going to have to pay for it. But also we have some legislation even coming up 3 years from now. And it's in 2017, Congress passed the Tax Cut and Jobs Act of 2017. And in order to, let's say get it through and to meet the budgetary restraints, it could only be temporary. So in 2017, rates were here, then they went down, and in the year 2026, they're scheduled to go back up here. So unless Congress does something to kill a tax act that's already been passed, so you would need a functional Congress to make a proactive change, or, I see a little sarcasm about Congress there, our tax rates are going to go up in a couple years. So, and by the way, the estate tax, the federal transfer tax, which right now is, if you're married, it's 20, I think there's a $23 million exclusion. That's going to come back down to maybe 10 million plus inflation, which is what it was in 2017, which was 10 million, and then add inflation on top of that. But let's take a look at the tax rates. So this year, your taxable income can be as high as $364,000, and you're paying at the 24% bracket. Now let's say Joanne is, her income, I'm just going to make this up, is $100,000, all right? Well, that means that she could do a and I'm oversimplifying, she could do a $264,000 conversion and should be in the 24% bracket. In 2017, that would have put her in the 33% bracket. And if the taxes go back up, that means that she'll be making a 24%, she'll be paying a 24% to save taxes at 23%. All right, and by the way, I didn't even include this in all my assumptions because it is speculative whether the tax rates are going to go up or not. But it's a good reason as a practical matter that we can assume taxes probably are going to go up. Here's another one that a lot of people don't know. How many people here are married? Oh, okay, we have a lot of married folks here. Well, what happens in the real world, if you've been preparing wills as long as I do, everybody always says, well, what happens if something happens to us at the same time? In the legal parlance, it's called a simultaneous death. That rarely happens. What happens probably 99% of the time even more than a year difference, is you have one person of the married couple die and the other one survives. All right? The survivor will not be able to, they can file as married filing jointly the year of death. After that, they have to switch to single. All right? Well, the single rates are much, much higher. So you want to do your Roth conversion while you're both married and you're both kicking. And I don't see that in the literature. I don't know why. To me, it's important. Normally, I want to do the Roth sooner rather than later, but that is another argument for doing it sooner rather than later. Okay. Secure Act, well, actually, before we're about to start something new, so why don't I take questions on what we've talked about up to here? Joanne.
What is the earliest age for a child that a Roth IRA can be opened?
Okay, the question is, and by the way, since I'm an attorney, I'm allowed to take any question and answer any other question. But the question is, what's the earliest age that a child can open a Roth IRA? And the answer is, in order to have any IRA, whether it's a Roth IRA, regular IRA, you have to have earned income, okay? So I'm not an expert in child law, child labor law, but the child has to have earned income. In the literature, there were some parents who tried to get earned income for their infant by paying their infant for modeling. That's a little aggressive for my taste, but you know, if you're 12 and you have a little, maybe you're a babysitter and you actually report it, or maybe you help your parents with their business. And I don't want to do a sham for both tax and for, I don't like kids getting money for not working, if you say it's for working. But that's the answer.
So are capital gains, dividends, and interest considered income?
Or capital, no, not for that purpose. You have to have earned income. Yeah. Yes, sir.
Based on what you said, then you're with the Secure Act, even if you're doing Roth conversion, even if you probably want to consider maybe even allowing some conversion to bump up into the next tax bracket, just to try and avoid what's going to happen in 27.
So the question is, and by the way, it shows a good understanding of what I've been talking about. Does it sometimes make sense to not only go to the top of your bracket, but actually even go beyond that? And the answer is yes, but here's where it gets a little tricky. And this is why it's really good to have number crunchers that know what they're doing do this analysis. A lot of times, if you add a certain amount of money, it can change your bracket more or less than you think. So for example, it might increase taxability of Social Security. It might, for this crowd that's a little bit older, it will very likely increase taxability of Medicare Part B, or your Medicare premiums. It might push you into an extra 3.8% for investment income that isn't taxed at lower rates. So you really have to watch what the true marginal tax rate change is. But in general, am I open to doing a Roth conversion even if it'll push you into a higher bracket? I'm going to sound like a lawyer, say it depends. I'm much happier going from 22 to 24 than I am from 24 to 33. But I think you generally have the right idea. Okay, anything else before we move on? Last one.
Clarification on the example you have there. So, so it's that Joanne on the left, right, and it's you on the right. Now, Joanne will pay, or you will pay. Sorry, it's Joanne on the right.
I wasn't going to correct you, but go ahead.
But she will pay more taxes than you would because of the Roth conversion. Because you're in the Roth conversion, so you're paying tax on the Roth conversion, plus whatever tax you might have to pay on your income, correct?
Right. So in both cases, I'm assuming that there is room in the 24% bracket.
Okay.
You don't get to ask the same question twice.
But you would pay, or she would pay more taxes because it would be 24% of the 100,000 plus whatever else.
Well, hang on a second. I'm assuming that let's say that she is between 190 and 364, all right?
Right.
And let's forget about Medicare and Social Security and all that. Let's just say for discussion's sake that her income is $200,000 exactly, okay? And my income is $200,000 exactly. And she does a $100,000 conversion, okay? She's still in the 24% bracket,
Yeah,
okay?
but now that applies to 300,000 in her case and only 200,000 in yours.
No, because she was at 200 paying so she's going to have to pay 24% on that extra $100,000.
Which you wouldn't have to pay.
Well, the person who converts is the one who has to pay it, right?
So,
So I'm Mr. Status Quo. I have the $24,000 of after-tax dollars. And in my assumption, I am assuming that I have the $24,000, that I'm investing the $24,000. The $24,000 that I'm investing, I have to pay taxes every year on the interest and the dividends, and every once in a while there's a sale for a capital gain. She has $100,000 in the Roth, and she doesn't have to pay taxes at all on the growth. Then we're looking at this over time, and oops.
I'm fine with that.
Oh, okay.
Yeah, all that's good. And you don't have to convince me that Roth conversions generally make sense, and more so now than before. So I'm sold on that. It's just,
Okay, good. All right.
just my algebra 101 in me.
Yeah, but by the way, we're talking about a razor-sharp CMU professor here, so he went a little bit beyond. And then speaking of smart professors,
I have a question about the taxation on the Roth IRA. I understand that there is no federal or state tax on the Roth IRA,
Mhm.
right? But when you transfer that money to your descendants, is there an inheritance tax paid on that?
all right, so the question that I'll phrase a little differently, is there inheritance? And we're talking about transfer tax now. All right, so in the US, there's basically two systems. Well, there's more, but for our purposes, there's income tax and then there's transfer tax. When we think of transfer tax, in the old days when the exclusion was 600,000, federal transfer tax was a big deal. Now, federal transfer tax is not a big deal for people who have, say, less than $10 million. All right? But income tax is a big problem for all of us, and I'm more of an income tax guy. But the question is about inheritance. And is a Roth IRA, so let's say you live in a state like Pennsylvania. Let's forget about federal. So you live in Pennsylvania, and there's a 4.5% tax for lineal heirs, kids and grandkids. All right? So Joanne, and let's say that we both die, Joanne and I die the day after we make the conversion. All right? So she has $100,000 in purchasing power. She has $100,000 total. So she has to pay $4,500, or her kids have to pay $4,500 in transfer tax. Okay? And it's a Roth, but she still has to pay transfer tax. I, who didn't do the Roth IRA, I have $124,000. So my transfer tax is actually higher than hers, meaning that I not only reduced future income taxes, but I actually reduced further transfer taxes. And by the way, I didn't include that in how much better off I was. If I did, I would be even better off. Now, if you lived in Texas or Florida or somewhere, the taxes are even more favorable, because there's no inheritance tax, there's no income tax.
And when you did that growth of the Roth IRA, did you take in consideration rate of inflation? Was it inflation adjusted?
Oh, no, I use, in effect, inflation-adjusted dollars. If you want to be very precise, I use 6.5% rate of return and 3.5% inflation. All right, which I think is pretty accurate over about 50 years. Right now, before we were less than that, right now we're more than that. But I'm using a long period. And by the way, if I wanted to make the numbers bigger, I would have used like 7 or 8%. But, this crowd doesn't like using aggressive numbers. Okay? But for transfer taxes, it saves money. And the other way, of course, is, move to a state that doesn't have a transfer tax, like Florida or Texas. Problem with moving to Florida or Texas is you have to live there. Sorry about that for you Florida and Texas people. I like to take little cracks. So anyway, it's good for inheritance tax. Okay? Okay. Now we can move on to Secure Act 2.0, which has like 500 provisions or something like that. Most of them don't affect very many people. But let me tell you the ones that will affect a lot of people in this room, virtual and here. If you were born 1951 to 1956, your required minimum distribution just changed from what used to be April 1st of the year after you turned 70 and a half. It turned to age 73. All right? Between 57 and 58, 74. If you were born in 59 or older or later, it turned to 75. That is useful. That's giving us more time to either be in a lower tax bracket or to make more Roth IRA conversions. So we can make smaller Roth IRA conversions for a longer period of time. So this is very useful. And this is relatively new. The Secure Act, which was effective January 1 for people who died after January 1, 2020, was absolute misery. And it was particularly miserable for the people I serve who tend to have big IRAs. So let's say that Joanne and I each have $1 million in our IRA. And Joanne dies on December 31, 2019. And with $1 million in her IRA. And she leaves it to her kid. And I die 1 day later. And I leave that same $1 million to my kid. Let's compare my kid versus her kid over their lifetime. My kid is out of money when her kid has over $2 million. All right? This act is horrendous. And I'll tell you what really peeves me about it. This might sound a little political, and that's not what I want to do. But we had a deal with Uncle Sam. Uncle Sam said, we're going to give you these tax-favored vehicles. And you could put money in them. You could get a tax deduction. The money won't come out until you take it out. And when you die, your kids get to stretch this inherited IRA over their entire lifetime. That was the deal. So a lot of us said, okay, that sounds pretty good. We'll put money in our retirement plans. We're going to keep making sacrifices so we can have more money. And this is going to be a really great thing for our kids. It's good for us and it's good for our kids. And then the government, late in the game, after we've already done this, the legal term for it is called detrimental reliance. Government says, we changed our minds. We're not going to let your kids stretch the inherited IRA over their lifetime. they have to pay tax on the whole thing within 10 years of your death. That's the only difference between my kid having nothing and Joanne's kid having $2 million. And it's, I've been saying don't pay taxes now, pay taxes later. In the accumulation stage, the distribution stage, and even after you die. The only difference between these two numbers is when our kid paid taxes, all right? My kid paid it sooner, her kid paid it later. Okay? That's what the Secure Act is, and I hate it. Yes?
I have a technical question on that. Suppose the IRA is all with TIAA, like some of us are.
Okay?
And when that money is transferred to your descendants, they have 10 years to take it, right? They have 10-year period.
Under the new law, yes.
Right. So what happens, where does the money stay? Does the money stay with the TIAA, or it will be transferred to the inherited person?
Well, interestingly enough, since I just wrote a book on TIAA, I happen to know that pretty well. There are significant transfer restrictions in TIAA for people who are kicking. After you die, TIAA will let you take the money out. In fact, when I give a talk on, I call it the greatest mystery of life.
Can they leave the money in TIAA and withdraw, 10% each year?
The answer is yes, but they don't get to keep your favorable grandfathered TIAA rate. Okay? And I don't want to go more about TIA, but I literally have a whole book on it. But it's only, but you'll be disappointed. You know why? It's only 550 pages. I'm really sorry about that.
But when they take the 10% a year, they have to pay the inheritance tax also.
No, they have to pay inheritance tax, within 9 months of your death. All right.
Yeah, I was kind of wondering, will the transfer take?
Yeah. I have to move on because this is a specialty question. Okay. There are some exceptions to the Secure Act. The most important, thank goodness, is your spouse. You can leave as much money, you can leave, if you're a U.S. citizen, you can leave $1 billion to your spouse and there's no tax. You can die and there's no tax on the transfer. It's called the unlimited marital deduction. And those of us in Pennsylvania can thank Governor Ridge, who made an unlimited marital deduction for Pennsylvania residents. And by the way, I've been practicing long enough that we didn't have unlimited marital deductions. All right? And that was nasty when your spouse died and you had to pay inheritance tax. I actually did estate tax returns for married couples when the person left everything to their wife or their husband.
So even if it's a combined property?
Well, for joint property, I should remember this. No, joint property I think was exempt. Now, of course, it's not. Okay, spousal beneficiary, but now, and I think it's 50 states, we all have unlimited marital deductions. All right, so you don't have that income acceleration in the Secure Act. Okay, here's a very big exception, and we're going to talk about this a lot in the third session today, which is if your beneficiary is disabled and qualifies for SSI or SSDI. By the way, even if you don't have a child with a disability, I would encourage most of you to stay for that third session because we're going to talk about Roth IRAs. And what I tried to do is, even though there's some repetition from this, is I just tried to do different examples and different, I have, I don't know, thousands, well, maybe not thousands. I certainly have hundreds. No, I have thousands of slides on Roth IRAs. And I tried to pick different ones just to vary it. So some people, it's good to hear it more than once with different examples. And it's also not as boring for me. But anyway, if you have a child who is disabled or chronically ill, and the technical word is an eligible designated beneficiary, They get to stretch it over their lifetime, just like people who died before 2020. Okay, another exception, but it only applies until they're 21, is if you are leaving money to a child, not a grandchild, by the way, and not a niece or nephew or friend. It's just a child. If the beneficiary is less than 10 years younger than you, all right, that would typically apply to siblings or unmarried partners. I guess theoretically it could apply to a stepchild. Charities and charitable remainder trusts, which we're not going to cover today, very interesting topic for people who are charitable. All right, but the point is, with the Secure Act, there's going to be a massive taxation of your IRA and retirement plan when you die. Massive and quick. And when you work the math out, one of the advantages of doing the series of Roth conversions is it will take out that enormous tax. So let's say, for discussion's sake, you die with a $2 million IRA, all right? And your kid has to take it out in 10 years, all right? That's increasing their income by $200,000 a year, all right? And Pothen is very aware of tax brackets. Oh, I'm sorry, no, it wasn't you. You're the tax bracket man, I'm sorry. Very aware of tax brackets. And that's one of the reasons why the Roth works. All right? It's Rabakar, not Pothen, who's the tax bracket man. Pothen's I have a couple technical questions. I'm sorry. I hope it's I've known both of these guys for 30 years. Go ahead.
My question is, so since the traditional IRA changed the way they taxed it, is it possible that the Roth IRA will change?
All right. I'm going to rephrase the question a little bit. Them rascals in Washington, they promised us we weren't going to pay tax on Social Security. And guess what? We're paying tax on Social Security. Are they going to make us pay tax on the Roth after they promised it was tax-free? In which case, we listened to Lange, we converted our Roth, and now they're going to tax the Roth anyway, and we're not only not better off, we're worse off because we paid the tax on the money. Is that a fair recharacterization of the question?
Right.
All right. Here's why I can't guarantee 100%. Here's why I think that will never happen. When they said we're never going to tax Social Security, we have a legal word for it called dicta, meaning it's something that a judge or a legislator or a politician or a president said that didn't have the force of law. It was just what somebody said. It is part of the Internal Revenue Code that this Roth IRA will never be subject to income taxes. All right? To change that, they could change it prospectively. In the future, Roth IRAs, future Roth will be, but for the money that's in there now, and until they make that change, I believe that money will be grandfathered. Because to not grandfather that money, you would need, again, to sound like an attorney, you would need something called an ex post facto law, which is a law after the fact that applied to something that happened earlier. That's a violation of due process, it's a violation of the Constitution, and you would have a very well-funded revolution. These people have money. These aren't just a couple guys with signs. These are... I don't think that's going to happen.
So when they did that with the traditional IRA, there wasn't that type of...
No, there was nothing in the code that says that we can't accelerate it. This is part of the Internal Revenue Code.
Okay, so the other one was not.
No.
That's how they got away with it.
Yeah. I mean, I think it was a money grab. And it wasn't a money grab for multimillionaires. It was a money grab from people who had $500,000, $1 million, $2 million. I really disagreed with it politically. And I'll tell you what a powerful guy I am. So when this was going on, I started a Facebook group called Save Our Stretch, all right? And I wrote to all the Congress people, vote against it, this is terrible, blah, 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 blah. It passed, I think, like 98-2. So you now know what a powerful political figure I am and how much influence I have with Washington. That said, I do a lot of work that's kind of on the cutting edge. And I usually like to talk about it to the world, and I write about it and things like that. And I met a guy who had a very high up position at the IRS socially. And I wanted to give him my book, and I thought about it. Better not give him my book. Even though I do try to get as many books out as I can. I actually just bought 3,500 of my own book for printing yesterday, the new book coming out. So here is, if you convert with Roth and you die, your kids won't have that massive taxation, which means more money can be taxed at a lower bracket. Okay?
I have one other question. So when they inherit the Roth, can they use the Roth to pay the inheritance tax?
I don't like that, but it's possible.
Because we're talking about the kids that don't save money.
Right.
That won't have the money.
But see, you save money. So you're not
My
gonna,
money will
you're,
pay it.
yeah,
Okay.
you're gonna use, they're gonna use your money.
To pay that.
Yeah. So here, by the way, is one of the problems for the people in this room, okay? You notice that your kids have nicer kitchens than you? And they spend more money than you, even though they don't have very much savings? And you always think that they should save more? Here's the irony. You know that, they know that. You're still not going to spend all your money. You're going to die, leave them a lot of money, and their lack of savings is going to be bailed out by you, who left them a lot of money. And you know that, and you're still not going to spend all your money. And that's true. That's true of 95% of my clients. All right, so we are at a good breaking point. This is what I will say at the end of the session. I will talk about what we offer, and I will oversimplify it for our purposes now. You could become an asset under management client, and to oversimplify there, we don't manage money ourselves. We use another money manager who's very, very good, who uses low cost enhanced index, scientific findings, data driven, the whole bit. And they charge roughly 1% on the first million, and then as you go up, a lower and lower percentage, which is, let's say, fairly standard or maybe a little bit low in the industry. And if you went to them, that would be the fee. If you do me, it's the same fee, but you also get a financial master plan, which is me getting involved, one of our number crunching CPAs getting involved, probably spending about 30 or 40 hours, and we'll talk more about it. But we're looking at legal, we're looking at your documents, we're running the numbers, we're looking at what ifs, we're looking at gifting, we're doing all kinds of stuff, and it doesn't increase your fee. And we do annual reviews, all right? Or you can just pay us, say, Jim, I don't want assets under management, but I recognize the value of the kind of work you're doing, so I'll just pay you a flat fee to do that work, all right? By the way, we did very well on Thursday. We have this book coming out. We're going to get very busy. If you are interested in having a consultation with me, I would fill out this form, give it to Aaron or Erica at the back. They will number it because, we're trying to be fair about this. And if you qualify, and this is what I mean by if you qualify, if I don't think I can save you a lot of money, I won't take you. I don't want your money if I think everything you're doing is right. Life's too short. I have enough choices of people who I can work with. So don't worry that, oh, I'm gonna have to pay Lang a whole bunch of money and I'm not gonna get any benefit, because that's not the kind of client I want. You know, I like clients who I think I can save them a lot of money or help their family.